Good afternoon. So we had a pretty volatile week. I mean, it's clear that risks are quite elevated. You see this big gap down we had on Monday, which was as a result of the Chinese intervention in their currency. So we had a couple of gap downs here. In the middle of the week, the Trump administration designated China as a currency manipulator. So it seemed like we were in a full-blown currency war here. So it's quite extraordinary actually that the market, despite all the volatility, recouped a lot of the losses towards the end of the week. And look, it was a combination of things. One, I think after the Trump administration designated China as a currency manipulator, I think there was a little bit of a reaction on the Chinese side, or maybe a telegraph from the Chinese side that they are willing to engage in negotiations, and they do not want or want to avoid a full-blown currency war. And that's really what caused some of the rally back in the stock market. So look, our view, I mean, if we pull back on the chart a little bit, you see here, we had just 2-3 weeks ago, we were talking about this breakout in the market. That, of course, was broken now with all the currency war issues that are floating around. And you can see we broke the 50-day line, and we didn't really violate the long-term average, which is the 200-day line. So for the market to go higher here, I think we really need to retest these long-term averages. So in the near term, we would be very cautious here, given everything that's going on. In terms of the timetable of things occurring, we would watch for the September 1st date. September 1st is when the new tariffs are supposed to kick in. It's a 10% tariff, and the Chinese have intervened in their currency to offset that 10% tariff. The yuan is now at 7 to 1, which is offsetting not quite all of the 10% of the tariffs yet, but some of it. So our view is a lot of this may come to a head around September 1st. So we would expect a lot more volatility in the market until then. So in terms of earnings, we had a couple of interesting companies that we own that had earnings out during the week. Disney was one of them. It was the first time Disney had consolidated earnings out after all the acquisitions it made. Basically the Fox assets, which included also more ownership of Hulu and things like that. There was massive confusion amongst the analysts, which was quite, I think, expected, given there aren't very good comparisons. So there was a little bit of a disappointment on the earnings side there, which we expected. We like Disney a lot. It's one of our core holdings, and we will look towards future quarters to see how their streaming business, their strategy to launch a new streaming business, which starts in November, on November 12th, how that will affect their bottom line. In the near term, they lose streaming revenues or royalty revenues actually from Netflix as they pull assets off of those other third-party platforms and migrate them back onto their own platform. So that may create some volatility in their earnings. But look, at 13 or 14 times earnings, Disney was a very attractive stock when we bought it. It certainly deserves a market multiple, and we believe their growth is back on track. The other interesting stock that had earnings out was CVS. This is a turnaround story that we added to the portfolio recently. CVS is an interesting company because it's trying to transform itself into a healthcare clinic. It's obviously a pharmacy as well, but they are now transforming many of their stores into healthcare clinics, and that's a niche that they are trying to fill in the healthcare services industry, and we believe is quite lucrative. I mean, CVS has about 9,000 stores. They touch very lucrative urban areas or city centers. So there is a real need for this healthcare service, which would be a very basic clinic that gives you everything from flu shots to prescription drugs. Certainly for the elderly, this would be a type of a clinic that they can visit more often. So CVS had very good numbers. The stock was up nicely on the day, on a very negative day for the market. So at 8 times earnings and a 3.6% dividend yield, we think the risk reward for CVS is pretty attractive here. So in terms of the broader market, our colleague Terry Gardner just ran the numbers for our CJ Lawrence Market Monitor. The Market Monitor is a model that we've run since the 1980s, which looks at the relative attractiveness of equities versus bonds. The Market Monitor went to 5, which is a screaming buy for equities. So our message is, yes, the risks are elevated here for equities. We have to be very careful. I mean, it doesn't feel like our portfolios are up 20%, but our equity portfolios are actually up 20%. Our balanced portfolios are up around 15%. That's a pretty nice return. So could we give up 10%? Yes. But we could also go up a lot higher, given there is really no alternative at the moment to equities. And that's really what our Market Monitor is saying. If you look at the earnings yield in the equity markets versus the earnings yield for bonds, it's quite compelling to be in equities at this point. So, I mean, the message is risks are higher, stay the course with high quality equities, and we'll keep you posted in the next couple of weeks. Take care.